So in this video I want to continue to look at the balance of payments, and I'm going to be looking at it in relation to the UK, and the two things I want to discuss are the factors influencing the size of deficits and surpluses on the three components of the balance of payments, and the significance of having a deficit or a surplus in the current account. So the balance of payments is a record of all the financial transactions that go on with the country and in one particular country and the rest of the world, and it's made up of three accounts: the current account, the capital account, the financial account. Now I'm not going to go into too much detail of what these accounts are about because I have another video which feel free to look at, which explains this. This I want to look at in relation to the UK and the significance of things like this. Well, the current account in the UK seems to be consistently for the last so many years. I haven't bothered to look up for how many years, but I know that I would say for the last 10 years or so it's had a deficit, the current account. And in this video I want to be looking at how the current account has had a deficit, but we're going to be looking at it in relation to the fourth quarter of 2010. So by fourth quarter I mean October, November and December of 2010. The one thing you have to bear in mind, it was Christmas, so when we look at the trade of goods, that's likely to be higher than any other quarter, because this is the time when people are buying gifts and stuff for Christmas. Okay, so I'm looking at the fourth quarter, and I've done most of my research through this PDF I found on the Office for National Statistics report. You can just Google it, you'll find it too, so you can have a look at it. It's just a PDF. So altogether, the current account deficit total figure came to minus £10.5 billion. It was a deficit. Now, how did this happen? Well, the most significant and most contributing factor to this deficit was the trade in goods of minus £26.8 billion. So we imported much more than we exported, and that was of £26.8 million. Then our trade in services, however, we exported more than we imported. So we got a positive figure of 12.1 billion. Then net investment income, which is things like people making money abroad through interest, profits and dividends. This was also positive, so people in the UK were making money abroad, and that came to 10.3 billion. But then our international transfers, which is money flowing between governments, so like the UK government having to pay for fees for being part of the EU, the IMF, giving aid to developing countries, things like that. Our giving of money was much more than us receiving money, so that led to a net figure of minus 6.1 billion. And this, so if you do minus 26.8 add 12.1 at 10.3 minus 6.1, you get the current account total figure, which is minus 10.5 billion. Now this was minus 2.9% of GDP, so it's not as bad as it sounds, because the problem arises when you start to get minus 5% or plus 5% of GDP is when the current account starts to become a bit of an issue. So it seems to be doing fine, and also it makes sense that the trade in goods is our biggest sort of factor which is contributing to the deficit held by the current account, is that because in the UK we're a Western economy and we have a consumer driven economy. Okay, and the second part of the balance of payments. So we've done the current account, now we have the capital account. Now the capital account is money made on fixed assets. So for example, in my other video I gave the example of when, because immigration in this country is constantly increasing, more immigrants are coming into the country, they come in and they buy more of UK houses. So this means that that is also a type of export but in a different way. So this looks at fixed assets and the transactions that occur with this. In the fourth quarter of 2010, we had a surplus of 0.8 billion, and this was an increase from 0.2 billion from the previous year. It was an increase. So either we can look at some data for immigration and look at whether that's the main contributing factor. I think it is, that immigration is the main contributing factor to why it's there's been a rise of 0.2 billion, and so we have a surplus there. The last account is a financial account. Now, this is money made from financial assets such as shares, hot money, things like that. And we had a net inflow. So the total, grand total figure for financial account was 16.1 billion. So it's a good figure to have, because this is going to fund our current account, where we are. This is going to fund us essentially buying the goods from abroad, which is leading to us having a deficit in the current account. So what was the biggest factor that was contributing to this 16.1 billion figure in the fourth quarter of 2010? It was other investment. Now, what I understand by other investment, I'm not sure if it's correct, but essentially what I think it is, the UK residents putting deposits on all sorts of kinds of investment. There's loads of different types of investments, and UK residents putting money, a deposit on these and making returns. That's what I think it is, but I'm not completely sure. But all you can remember is that it was 16.1 billion surplus, and the biggest contributor was other investments, so it wasn't financial derivatives or whatnot. And so what we do to get the grand total balance of payments, you do minus 10.5 from current account, add 0.8 of the capital account, then you add that to the 16.1 of the financial account, and that gives you a grand total of 6.4 billion. So we don't say that our balance of payments is in deficit, because actually it's not correct. The balance of payments is supposed to balance, so technically it should be zero, but it's not. There's an imbalance. And so if you want to talk about a deficit, when you talk about import, export, and things like that, and consumer welfare and trade, make sure you relate it to the current account, because what I've discovered is not actually the balance of payments as a current account, because our financial account and our capital account, they fund this. So the last thing I want to have a look at is the significance of having deficits and surpluses on the current account. Now, as we've seen, the UK has a deficit, minus 10.5 billion, fourth quarter of 2010 in the current account. Now, this is significant because in order to fund this, we have to be making surpluses on our financial and capital accounts. That means that we essentially need people from abroad to be investing in the UK. Now, that's fine. We're a stable economy. We're a good place for investment. This is where people would like to invest. But ultimately, it's debatable, because in the long run, if investors are putting money, eventually they want to see some return on it. Otherwise, why would they put any money? It's an incentive. They want to see something come to them from that investment they've made, and that could essentially lead to a deficit on these accounts. And then we would be back to square one, where it means that we need to sort out our current account. We need to boost exports, and we need to cut down on our imports, and we might end up using protectionist policies and whatnot. But I think essentially we can't compare our balance of payments to China's balance of payments, because essentially what the main thing is that we are a consumer-driven economy. We grow through consumption and aggregate demand. China does not grow through, well, it does grow through consumption and aggregate demand, but it's an export-led economy. Export is the main way it's grown, and they're two different ways of growing, and they're going to have two different problems. So that's why their surplus means that they need to be having deficits in their other account, which means that there's more people making money out of them than them making money out of other countries, which is also problematic in itself. I hope this video has helped. Thank you for watching.